Hey everybody, good to be here. It's time for Condors, Calendars, and Butterflies. It's Friday, our regular Friday session. Glad you're here and see some familiar names in the chat. Glad to have you there. And also, if you're watching on a recording, we're glad you're here as well. Today, we're going to continue our series that we've been doing. This is actually going to be, as far as I'm concerned, I think this is going to be the final week in our series where we go through different strategies, one at a time, kind of focus on the different strategy. This is actually uh, number 12 in the series. So we're going to talk about collars today. So I want to talk to you about those and give you examples of those and hopefully help you out. And if you're interested, you can go to the playlist in this series. I'll put it in for this webcast, Condors, Calendars, and Butterflies, and I'll put that in the chat. If you're watching on a recording, it's in the description. I put it in the description as well there. So that's for the playlist for this. So you can go back to past sessions. Now I'm joined alongside James Boyd in the chat helping me out. Thank you, James. Appreciate that. Make sure you check out James's Investing Masters series on Tuesdays, 11 o'clock Eastern Time. You can also follow us on X at Brentmore CS, at James Boyd CS. Options do carry a high level of risk and are not suitable for all investors. The material today is intended for general, informational, and educational purposes only. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. The paper money software application is for educational purposes only. And by the way, that paper money software application will not assign short options early, but that's different than your real live account there. And let's see, all investing involves risks, including loss of principal. There's no guarantee of execution of a stop loss order. It's going to be at or near the stop price. Past performance is no guarantee of future results. Schwab does not recommend the use of technical analysis as a sole means of investment research. And commissions, taxes, and transaction costs are not included in this discussion, but can affect the final outcome and should be considered. All right, let's head on over to the Thinkorswim platform. That's what we're doing there. Let me just close that down. This is the SPX. We're up today. We had some jobs numbers, which were a little mixed today. The payroll number was a little lower than I think some people wanted. Unemployment came down though. And sometimes it's not always a bad thing. If, sometimes the market will interpret, oh, a little bit weaker on the labor front actually may entice the Fed to be a little bit more dovish in their interest rate policy and their monetary policy. So it can be mixed. But anyway, the trend's continuing. We're going up. But here's the thing. We're about to hit earnings season. And of course, we have a lot of uncertainty with earnings season. We're going to get back to that in just a minute. But first, before we get too far into this, let's just talk about options. Why do people trade options? Because, options are different than stocks. Stocks are kind of, you can make a case for stocks and you can say, well, historically, over the long haul, when you look back in history, stocks have had this great performance. And I'm just talking in general over time. Look at the S&P 500 over history, right? Annualized, decade over decade. Options, you have these shorter expirations. It's not the same thing. Options are different than stocks in that regard. And that's not a forecast of what stocks are going to do or options are going to do in the future. I'm just saying historically that's how it is. But people turn to options for a number of different reasons. One is leverage. If you expect a certain percentage on a stock, let's say you bought a long call and the stock goes up, you may get an increased percentage return with that long call. Of course, leverage can work against you too, but that's a common reason people use options. Okay. Number two, income. There's income strategies. We talk about covered calls, short puts, short put verticals. We can go on. Income strategies. People like to be able to add income, and that can certainly help you if, the rest of the market's going sideways, bringing in some income. You can think through that. I don't want to go into too deep into that and take up too much time on that. I think that's a concept a lot of you are familiar with. Another reason, flexibility. And that's something we hit a lot in this webcast of, a lot of people are in stock mode, I think ABC stock is going to be bullish, and therefore I'm going to buy the stock. Well, what if you think the stock's going to be neutral, or going to go down, or be kind of neutral to bullish a little bit, or something like that? Well, option strategies, there's a variety of different option strategies that could fit the bill. And then there's another part of it, and that is options can be used for hedging and risk management. And that's what I want to focus on today, because that's really what we're getting at with callers. If you're super bullish on a stock and you're not worried about managing the risk initially on that, this isn't what we're talking about. We're talking about managing your risk here with the caller. That's our topic there. Now, risk management can take on different forms. Most commonly, probably, protective puts is what we'll talk about. You buy a put, and if the stock you own goes down, the put can go up in price and help offset the loss. So that's a common strategy. Covered calls, to a lesser extent, covered calls don't give you that much protection. They give you the extent of the protection they give you is the premium you bring in on the covered call. And but they can be used for different reasons. Covered calls are typically more of an income strategy, but we can exploit them a little bit to help us with this strategy, which is callers. And with a caller, what we're going to do is we're going to buy a protective put and we're going to sell a call, assuming we own the stock here. So let me give you an example here. I have in the portfolio, I have Delta stock, okay? Delta Airlines, oh, we have earnings coming up, okay? Here's earnings on Delta right down here. By the way, everybody, let me go to Market Watch. Let me go to calendar, and here's the earnings calendar. I don't know what today's the 9th. This is like Tuesday, I think, the 13th. Bank of New York Mellon, JP Morgan, Bank of America, Citigroup, Wells Fargo, and so on, BlackRock. So a lot of financial stocks, but other stocks as well. Delta's in here. This is just S&P 100. They may not be in the S&P 100, but yeah, Delta would be in here if I didn't have this limited to S&P 100. So these are just the 100 biggest stocks out there. Look how many have earnings coming up. Well, earnings season, right? So this is appropriate. Maybe you have the stock and you're looking at the stock and going, oh, Delta, I'm doing fairly well on the stock. I want to protect that over earnings. I'm a little iffy on earnings. And here's Delta. We've had a nice run up. I don't want to sell the stock. That's always a choice. You can sell the stock, but there may be tax issues. I can't talk about your tax. Your tax situation is different than anybody else's. It's unique. And I can't get into that other than to say there may be tax reasons that people decide, I don't really want to sell my stock right now. Okay, that's a possibility. Maybe you want to hold the stock and get a dividend. Looks like we're getting some dividends. It's not a huge dividend, to be honest, but a little dividend about, a week or so after the earnings, typically, historically. And so maybe I want to continue to hold it through and collect the dividend or something like that. So, or maybe you just don't want to sell it for whatever reason, but you want to protect it in the short term. So often what we'll do is we'll do a protective put on it. And so what we do is you can go to the trade tab, and I'm just going to go out past earnings. Well, earnings is Tuesday, so 7 days is gonna fit the bill on that. And I'm going to go out here and I'm going to use my Delta. I'm going to go to roughly a 30-ish Delta on that, and I'm going to buy a put. Okay, there's my put on that, and that's going to protect it. But one of the downsides of buying a put is it costs money. It's going to cost me about $130 for that. Okay, now that is great. If the stock kind of goes up, I'm probably going to lose most of that. If the stock goes sideways, I'm probably going to lose a fair amount of that. And if the stock goes down, if it goes down enough, I'll be probably very happy about that. But if it goes down just a little bit because of time decay, volatility issues and stuff like that, maybe I'm up, maybe I'm down. But that is a factor whenever you're doing protective puts. That's why you don't do them all the time to protect everything typically, is because it costs money. And you're introducing that negative theta into your portfolio when you buy that put. So what if we kind of subsidized that put by selling a call at the same time? So I'm going to sell a call here, and I'm going to go to delta around the 30-ish level, and I'm going to sell this, and I'm just going to hold on my control key for a sec. Now let's look at this for a sec. Now we bought the put for about 125, 130 bucks. Depending on what call I sell, I can either completely offset that or mostly offset that. In this case, it's still going to cost me about 19, 20 bucks or so on that. But it certainly reduced the cost of that, and it's going to reduce the theta, the time decay on that as well. And volatility considerations will be, they will largely cancel each other out because I have one long option, one short option there on there. But if I do and I add this, I can kind of model what this is going to be even before I submit this. Let me just analyze the trade. And let me do that's on there. So this is what my trade looks like now. Does this look familiar? Does this risk profile that you're seeing right now look pretty similar to some others that we see? Yeah, I mean, this looks like a vertical spread in a sense. But look, my gains are capped at 75. Well, no, 76 was where my strike was. Gains are kept at 76. This flattens out. So Greg says, but we're locking in the gains. You're absolutely right. So as with any strategy, there's pros and there's cons. The pros, here's the pros. We're capping our losses on that stock if it goes down. Okay, that's the nice thing. But there's no free lunches out there. Okay, we're capping, and by doing the collar, we're actually doing this for very little cost. But there's the downside. We are capping our gains absolutely on that. Okay. Now, can we decide? Now, I just kind of gave you a general, a general guideline. Oh, maybe 30-ish delta. Chris asked a good question. Can we look at, maybe we consider and we modify this based on the strikes, on how big a move we expect on this. Let me do this, okay? So let me go to January 16th, out a week, okay? Our move, our expected move based on the implied volatility is about $5.50. Well, where does that put my stock? That puts it about between 77.5 and 66.5 if I'm doing my math right. Okay. So could I do this? I can go out further on these if I want. These are actually inside the standard deviation move there. It's just pros and cons. If I move this tighter, the tighter it is, okay, if I do close in put and close in call, again, the price may offset each other largely, but if I put them in tighter, I'm adding in more protection, but I'm limiting my gains more. If I do them wider, okay, wider strikes, I have less protection. The protection really isn't kicking in to near the extent early unless I get a much bigger move on the stock, which is great, but it also gives me more potential gains on that. All right, so yes, Chris, no qualms there on that. Do do what serves your needs on that trade. In this case, I'm allowing myself a little bit of upside, okay, up to, what do we say, the 60, what was our strike, 69? No, I've lost track of my strikes. Up to the 76 level. So that's up here. I'm giving that much, but we can take that. So that's an alternative there. Remember, I can just do the protective put and not limit my upside, but then I have higher theta, negative theta, higher negative theta, and it's costing me up front. Okay, so there we go. So I'm gonna add that trade in there. Let me just bring that up, and let's just do. Let me just throw this down so that we can get this in there. Confirm and send, and I'm gonna throw this on in my long stock area. Okay, so there we go. Now, keep in mind with callers, is my delta neutral? Have I completely neutralized this trade? No, I haven't, because think about your deltas on this. My stock, 100 shares of stock, has 100 delta. My short option, my short call, has about a negative 30 delta. My long put has about a negative 30 delta, at least how I did that. As I mentioned before, you can tweak those. What's my net delta? My net delta is still about a positive 40. Okay, so that's not, it's still a positive trade there. Okay, so Rocco said, why are we doing a collar on this? We're doing a collar just because we have earnings coming up. Now, fair question though. Did I think it's flagging? Does it seem like, if you see a stock that's maybe extended too much and you think it's about to pull back, but you still want to hold it, that would be a time as well. But in this case, particularly, we did this based on earnings, okay? Just an earnings protection. Now, on last Wednesday, so a couple days ago, in the Managing Options Portfolio webcast, we talked about at the beginning of the webcast, so if you wanted to see it, we talked about doing selling calls when an option is flagging, okay? When the stock seems like it may be flagging. In other words, about to have a retracement or be overextended. If you're interested in that webcast, I put a link to the playlist for that class in the chat. It's also in the description if you're watching on a recording. Okay. So, but those would be kind of the two instances when you'd likely do a collar. Is there's some event that you're a little bit worried about, or you think the stock may be about to come back, or anytime you want to protect it, really. So what's a collar? Collar is long stock, short call, okay, so that together would make a covered call, right? And a long put or a protective put. Put those three things together, you got your collar. Do they need to be entered at the same time? No, we'll look at an example here in a minute where we're going to kind of layer them in, right? I mean, typically you would not enter in all three at the same time, because if you want this kind of more neutral-ish, I'd say ish, because we already discussed it's more positive delta, but you probably just change the timing of when you buy the stock in that case. But if you already own the stock, a lot of times we'll leg in with short call and protective put. That's the collar. Or maybe you have a covered call, long stock, short call. Then you can leg in with protective put, or some combination therein. So that's the basic thing. Now I said it's meant to hedge. it's a hedging strategy, right? And so let me just put another way, used to manage risk. All right. Number 3, typically layered into after own stock. After you own the stock, we're going to layer that into. Okay. Theta and Vega neutral-ish. Okay. You have a long leg and a short leg. Short call, long put. Theta is going to largely cancel each other out. Vega is going to largely cancel each other out. Okay. Expiration date. As long as you need protection. Okay. It doesn't guarantee, doesn't offer 100% protection, but it's there to help you. One thing with that long put is the more the stock goes against you, the more the stock goes down, the delta on that long put is going to go up, and that's going to offer you more protection as we go along. Okay. One way to think about it is that the put represents the protection level. So in our example, I think we picked the put at 69. That's really where, your protection kind of ramps up there. But so just kind of consider that. The closer you have that put, the more the protection you have there. The call represents not the protection level, but the potential level. Our stock would get called out presumably if we're above, at expiration at least. And there's always a chance on short options of early assignment. So that's the downside. There's an opportunity cost on this in a sense. We don't know what the protection, what the stock's going to do. And if it goes up a lot, you'll probably, not be happy you did that. But what the reason? Maintains stock ownership. Okay. And that may be for tax purposes, maybe for dividend purposes. I misspelled dividend there. Let me just do that. And let's see, I got a couple more here real quick. We already know what caps profit potential is. Okay, exit after period of concern. And one last thing. You can exit the call or the put independently of one another. You don't have to get out of the whole thing at once. Maybe you want to get out of the protective put and just leave the short call on there, or vice versa. All right. So anyway, if you're interested, you could, copy those notes, take a screenshot, whatever you want. Let's go back and look at another example here, though, on this. And let's look at one where, I kind of mentioned that you can leg in if you want to this. So let me just move this out of the way. And let's look at another example. So I've got Bank of New York Mellon. What do I have here on this trade? This is a covered call, right? I have 100 shares of stock and I have a short call. And I just did this short call recently. I just did that covered call recently. In fact, I just did it a couple days ago. I think that was one of them, 117. Yeah, that was just in that class I referred to already. So here's that. We did the covered call, but lo and behold, Bank of New York Mellon, it's one of those financial stocks right at the beginning of earnings season. You can see that right here. And if we're going to do this based on earnings, then, the call doesn't offer that much protection, does it? Okay. We brought in some premium upfront on that call. And that's nice. It brings in the time decay. But it's really not helping us if the stock goes down. I mean, the stock is a $119, $120 stock, that's $12,000 worth of stock. Okay, hey, okay, everybody. We were sorry about the little technical issue there on that. This is so Bank of New York Mellon. We've got earnings coming up in just a couple days, and I want to add some protection to this. So we're going to turn this covered call. Okay, I'm going to turn this covered call into a caller by adding a protective put on it here. So let's do that, and let me just go. I'm going to go to the trade tab. And let's look at this. So this is my existing call option right here. I can buy out. Now, look, it depends on how much protection I want on this. Our move here, based on that's 42 days. So this is buying a lot more time on the protective put. Now a true caller, these are going to be the same expiration. I could just put the protective put out 7 days. Nothing wrong with that. Nothing wrong with doing that. But on a true caller, they're going to be the same expiration day on that. And then you have your choice of your delta there. So that's going to offer more protection on this. Of course, I can always take it off at some point. But I'm going to go, and we said market maker move. So this is between now and our earnings, $4.50 on Bank of New York Mellon. So that gives me about a $124 potential, so to speak, on giving a standard deviation move, and down to about $115, which is right where I'm going to put that put on there. Okay, so I'm going to click on my ask price. I'm going to add this on. Now, I'm paying out $220 right now on this. However, we brought in a credit the other day. So I don't know what the credit was off the top of my head, but it is, so they will partially offset each other there. So we're going to collarize this Bank of New York Mellon trade as well. So I'm going to click on confirm and send. And I'm going to put this right in here with this. I'm going to send that order, and we have this. And so that's just an example of layering into a caller. So 187, there we go. So the put cost me 20 cents more than the call brought in on that. But hey, maybe that's worth it, maybe it's not. Now, are we going to put a collar on everything before earnings just because I gave you a couple examples of it? No, likely not. You're likely not going to hedge every position. Part of it is, hey, look, there's just a risk of being in the markets there. But if there's a particular, not just earnings, but other news events that you are anticipating that could be of a concern that you still want to hold that stock, then you may consider doing that. Okay. Now, let's go and let's look at another one here. Because the other day, I did a trade on Centerpoint. Okay. I have Centerpoint. I have a stock. I have a stop loss on Centerpoint. And if we wanted to, let's just kind of do it one where that's not based on earnings, because we don't have earnings for a little while on this. I'm not sure. Let me just look here. Let's go to analyze. Let's go to earnings. Earnings February 19th. So we have a little ways before earnings. So this is not an earnings type trade here. But let's do some protection on this. But we want to do protection that gives us potential on this. So in other words, maybe I want to add in some protection beyond, we have a stop loss. Stop losses aren't guaranteed. And I want to give this some upward movement. But let's do this. I'm going to go out. Now, we only have a choice of 7 days or 42 days on this. Okay? 7 days or 42 days on this. And ideally, maybe, we can show you different examples too on this. But if I want to go out more time, I can do that, and I can go ahead and sell a call. We'll go out to about 24 delta here on this. I'm going to buy a put, and the call is at 40. Is that enough? It's up here. It kind of caps us out in a sense up here on this. In other words, if I do this, I'm down at 39. I'm probably capping myself out more than I want to on this. I'm holding on this on for another month or so, and it's going to give me a pretty good range. And if it goes up there in that time, I'm probably happy on that. Okay. So, question on this. I'll give you this column script here in just a little bit if you want. Okay. Hold on. Just let me finish my train of thought here on this. And so we've got that. We have our short call. We're going to put on some protection on our put. Again, we're going to do a lower delta. So instead of the 30 delta on the high side and the low side, I'm going out further, giving us more risk, maybe leaving more risk on the table, but also leaving more potential on the table. This goes to the prior question on that. I just overwrote my other one. Let me just hold down my control key. There's my collar. Basically, almost no cost on that, okay, up front. I'm going to confirm and send that, and I'm going to put that in my long stock category and put that in. Okay. All right. So now with Centerpoint, if I bring up my Analyze tab on this and go to my risk profile, let me just show you. This is what it looks right now. This is where the stock is right now. It gives us this profile for a little while. Generally, we're going to get out when when the event of uncertainty is done with, or if it makes a technical move that changes our opinion on things on this. And in this case, this is a long stock. At some point, I may decide I want to get out anyway. Okay. I may decide I just want to sell the stock. Also, I may decide, maybe I'm holding this through right now. Let's see, we got earnings. This is a dividend, pays a pretty good dividend here as well. So that could be a consideration as to when I'm in these and why I may want to hold on to a particular stock. Okay, now here's the column. This is just a days till expiration column. Days till, excuse me, not days till expiration. This is days till earnings column. Okay. This is just, well, you can use this or not. It's up to you. So let me just go and share it with you. How about? And we're going to go share. Days till earnings. Share. Click on this. I'll put that in the chat for those of you who are watching live. And I will also, let me just do this. Put it in the scratch pad here. Sec. I don't want that. Those of you watching on the recording, that's a exclamation point G1FJU26F. It is case sensitive, by the way, case sensitive. And then for those of you who are newer, just copy that. You can copy the whole thing if you want, or just the exclamation point on, and then go up to the gear, click on open shared item, paste it in there, click on preview. It may ask you if you want to rename it. You can name it to just something that's clear for you. And then you import that. And then to add it to this page or to a watch list, you go to the gear. Here's all available columns. And here's your new column right there that I have in there. Okay. So hopefully that is of benefit to you. Let's talk about another couple trades here. Last week in this webcast, we talked about synthetics. Okay. We did some. We did a synthetic on Bank of America. Okay, so this was just a few days ago. We bought the call, we sold the put. You can hit up that playlist I already sent out for you for that webcast, and hasn't done much yet. Okay, so Bank of America is still going in there. Now, you could add, I'm not going to do it right now, but if you wanted to, you could add in another put to try and protect yourself on the downside. Okay, so that's our synthetic. In other words, let me go to my Analyze tab. And we were looking at what we were looking at, Bank of America. Okay. Type that in. Bank of America. Oh, BAC, Bank of America. That's what a synthetic looks like. Okay. If we want to, so this looks a lot like a stock. If we want to, we could add in a long put on this, say, I don't know, 53 strike. And then what the risk profile at that point would look like is this, right? It would look like that. At the same time, if I wanted to, we could sell something like a call around the 60. And that would then cap our gains out there. So that would adjust that risk profile to look like the similar risk profiles of those callers that we were looking at earlier. Is it technically a collar? No, it's not technically a collar because the collar has stock. This isn't stock. This is a synthetic. Okay. So there you go. All right. So yeah. And by the way, on these strategies that I'm doing here, not everyone's going to be approved for all these strategies all the time, right? So there's different levels of options approval there. So I'm not going to do the trade right now. This is not a caller, but just to get your mind thinking about that, you can add these trades in there. So let's do this. Let me look at another one. We also did in that same class on Wednesday, the managing options portfolio on Merck. last week in this webcast, we did that synthetic. Okay, we did that synthetic. And doing great, all in all, doing great. But we also added on a short call on that. So we didn't do the full, short call, long put. But the point is, on these other option trades, once you know the different little additions you can throw on, and we've been talking about some of those additions today, the short call and the long put, the caller, you can add them on to other trades. Even if we're not going to call them a caller, even if they're not technically a caller, you can do the same thing here on this. If we look at MRK, here's Merck, right? We did the short call, so we capped this out. We still have all that downside there. So we could add that long put on there somewhere and do that. It's going to cost us though, okay? It's going to cost us. And that nice positive theta we have right now is probably going to be mostly wiped out if we add in the long put there at the same time, okay? So play around with that, everybody. There we go. Now, I gave out a couple playlists. I encourage you to go to that Trader Talks channel. It has all our webcasts. We have over 30, I can't remember, over 30 webcasts a week on here, on Trader Talks channel, Trader Talks Schwab. So go there and subscribe. And if you're watching on YouTube right now, look in the bottom right. If you haven't subscribed already, you should be able to subscribe to that. If you've already subscribed, don't click on it again though. All right. Today we talked about synthetics. We talked about what synthetics are. We talked about pros and cons. The big con is you're capping your gain. The pro, you're capping your loss. It's a hedging strategy. And we talked about some of the kind of common practices that people use on those callers. And that's, just to get you started. But I would encourage you, go to your paper money, check out the best way to learn options is to play around with them on paper money, I think. It really is. Put on the trades on your paper money account and tinker with them. And then you can get creative, like adding on the short call or the long put on existing option trades as well. So hopefully that is helpful to you, everybody. Thank you for joining me today. Thank you, James, in the chat. Appreciate you. And next week, hey, we're done with our 12-week series. We'll hit a different topic, but look forward to seeing you then. Have a nice weekend, everybody. And coming up next, we have market and sector analysis. Bye-bye, everybody.